So we have discussed about excess demand and deficit demand. So next we are going to discuss about measures to correct excess demand and deficit demand. That we have already discussed in the chapter government budget and also central bank. So there are two types of measures to correct excess demand and deficit demand. They are first one fiscal policy measures and second one monetary policy measures. So fiscal policy measures includes taxation policy and government expenditure policy. Then the monetary policy includes quantitative control and qualitative control. Let us discuss it in detail. So first one, fiscal policy. These are taken by the government using budgetary tools like taxation policy and government expenditure. So first of all, taxation policies. So during excess demand, the government levies high taxes or new taxes during inflation or excess demand. It will reduce the disposable income of the people and therefore the aggregate demand is reduced. Then during deficit demand, the government reduces the rate of tax or bring liberal taxation policy during deficit demand. It will raise the disposable income of the people and leading to a rise in the consumption and investment expenditure by the household and firm. Then the second tool of fiscal policy is government expenditure policy. So in excess demand, in a situation like that of excess demand, government should reduce its expenditure on public work like construction of dam, roads, buildings, etc., thereby reducing the money income of the people and their demand for goods and services. Then increase in the government expenditure during deficit demand or deflation causes injection to the economy. As a result, aggregate demand and money supply get increased. Thus, the problem of deficit demand or deflationary gap in the economy get compacted. So, these are the fiscal policies to measure or to correct excess demand. Okay. So, the government expenditure and also taxation policy. These are taken by government to correct excess and deficit demand in the economy. Then the next is monetary policy measures. So, these measures that are taken by the central bank of the country. So, there are two types of measures to control credit or control demand or measure to correct instabilities in the economy, that are quantitative control and qualitative control. We have detailedly explained about this in the chapter money and banking. So just recall all those concepts. Okay. So first of all, quantitative control. So the quantitative controls are bank rate, open market operations, then legal reserve ratio, etc. So first one, bank rate. What do you mean by bank rate? The minimum rate at which the central bank of a country provides financial accommodation to commercial bank. That is known as bank rate. So during excess demand or inflation time, central bank increases the bank rate. So a higher bank rate is aimed at raising the cost of funds that are made available by the central bank to commercial bank, which in turn raise their own lending rates to the borrower. As a result, the higher rate of interest, borrowing by the firm decline and thus bank credit contract, thereby reducing money supply. Okay. On the other hand, during deficit demand, central bank reduces bank rate. So a lower bank rate is aimed at reducing the cost of funds that are made available by the central bank to the commercial bank, which in turn reduce their own. Their own means commercial banks lending rate to the borrower, and as a effect, the firm may feel motivated to borrow, thereby increasing expenditure to tackle deflation. Okay, so during inflation time, central bank increases the bank rate. Then during deficit demand, central bank reduces the bank rate. Okay. Then the next quantitative method is open market operation. It refers to direct purchase or sale of assets like foreign exchange, gold, government securities, etc. So during inflation time, central bank sells assets. Then during depression, central bank buys assets. Then the next, legal reserve ratio. It refers to the minimum amount of deposit which the bank are mandated to keep as cash themselves or with central bank. So commercial bank have to maintain a portion of their deposit either themselves or with central bank. So that rate is known as legal reserve ratio, LRR, and it has two parts, cash reserve ratio and statutory liquidity ratio, CRR and SLR. So during inflation, central bank increases CRR. During depression, central bank reduces CRR, cash reserve ratio. Then during inflation, central bank increases SLR, statutory liquidity ratio. Then during depression, central bank reduces statutory liquidity ratio. So cash reserve ratio means cash reserves of commercial bank with central bank. Then statutory liquidity ratio means cash reserves of commercial bank with themselves. Okay. Then the next is repo rate. It is the rate at which the central bank lends money to commercial bank for short period or short term or for few days. That is known as repo rate. Bank rate is for long term. Then here repo rate is the rate at which the central bank lend money to commercial bank for short period. Then during inflation period, central bank increases repo rate. Then during depression, central bank reduces repo rate. Ready to purchase offer, that is repo rate. Then the fifth one, reverse repo rate. It is the rate at which commercial bank can deposit their surplus fund with central bank. Repo means the rate at which the central bank lend money to commercial bank. Then a reverse repo means it is the rate at which commercial bank can deposit their surplus fund with central bank. Then central bank will give interest to that deposit. The rate of that interest rate is known as reverse repo rate. So during inflation, central bank increases reverse repo rate. Then during depression, central bank reduces reverse repo rate. Then qualitative controls. So what do you mean by qualitative controls? Qualitative controls means these are designed to curb instability in the economy. That is credit control in selected area without affecting other types of credit. So the quantitative controls are, first one, margin requirements. It is the difference between current value of security and loans advanced. So during inflation, central bank increases marginal requirements. Then during depression, central bank reduces margins. Okay. Then second one, regulation of consumer credit. During in inflation period, the central bank asks the commercial bank not to grant loan to consumer. So during depression, central bank may adopt liberal credit policies. Okay. Then third one, credit rationing. That is fixing the restrictions on credit to specific categories of loan. Okay. It will not affect other types of loans. Fixing the restrictions on some specified categories of loans. So during inflation, they strict credit control over there. Then during depression, central bank adopt a liberal credit policies. Then the fourth one, moral suasions and direct action. The central bank pursues the commercial bank to follow its directions on the following of credit. Otherwise, central bank will take direct action on commercial banks. So these are the measures that are taken by the central government to control excess demand and deficit demand. Okay students, that was today's sessions. So with this topic, our third chapter get finished. Okay. So in this chapter, we have discussed about what all things? Aggregate demand, aggregate supply, determination of income and employment, investment multiplier, then the problem of excess demand and deficit demand. So students, this is an important chapter. Then you have to study it well. Then as usual, you have to watch the URL, attend the test paper, download your notes and study it well. So children, this is our final chapter. With this chapter, our macroeconomics get finished. Okay.